Section 3 of Topic 6, Paper 8 takes us to the last section of the Paper 8 material, and that is technical analysis. Now, there is a lot of material on technical analysis, but I would say there will be one, maximum two questions in the exam. So you got to take this with a pinch of salt. That is to say, I wouldn't be reading this so that I know it all inside out. I would pick up the main features so that if a question comes up, you've got a reasonably good chance of getting 50% of it correct. And then, well, sometimes we have to do a bit of guessing. My advice is that if there is elements of technical analysis that you feel comfortable with, then know it for the exam. If there's other material you think, really, I'm not sure if I'm getting this, be aware of it without going into too much depth. Having said that, let's start section 3.1. The fact that technical analysis is looking at historical data to help predict the future, especially in terms of pricing. So we're told technical analysis evaluate securities by using historical market data to predict future market trends. That's just what I've said. Technical analysts assume that previous pattern and price moves will repeat themselves, and it relies heavily on charts and historical data. Technical analysts are sometimes referred to as chartists. So let's start with section 3.2 on charts and trend lines. We've got line charts, bar charts, candlesticks, and point and figure charts. Now, you could be examined on all of them, asking you which one of the following is not a technical analysis tool, and they give you three, and then the fourth one is a distractor. Or they could ask you maybe for each one of these charts or methods exactly what it is. So we start with the line chart, very simple. Over a period of time, we plot prices and we are looking at the pattern. Top of page 18, we've got a bar chart, and that shows for a particular day the opening and closing prices in relation to the highest price and lowest price recorded for that stock. The candlestick chart, two ways of depicting it. One, we fill in the box, referred to as a dark candle, and one we leave blank, the white candle. And there we, again, similar to the bar chart, we're showing the highest price, the lowest price, and the difference between opening and closing price during the day. Then we come to the point and figure chart, the X's and O's. Now, I've seen this examined. Please be aware that as we go to the right along the x-axis, it's the passage of time. Vertically, it's 1 day's trading. So if the price goes up, we note it with an X. If it goes down, we note it with a 0 or a naught. So you can see the first column is all X's. That means that the price on a day went up, and then it starts to go down. That's the naughts. Then it reverses and goes up. And you can see that we've drawn in resistance and support lines. So the price never goes above the resistance over the medium term, and it doesn't go below the support. So just remember, X is upward, naught is downward. Then we look at trends. Now, three possible directions for trends. You may say, well, this is just screaming obvious. Up, down, or sideways. Uptrend, series of ascending price peaks and troughs, whereas a downtrend, series of descending peaks and troughs. Sideways trending, there's no new highs or lows. Now, the trend lines used by technical analysts to establish critical price levels called support and resistance. Support is where the price will go no lower. Resistance, the price will go no higher. And we're going to consider those in more detail now. So without insulting your intelligence, we're showing you what an uptrend line looks like, with a little bit of highs and lows on the way up. Similarly, page 20, we have a downtrend line. Now, a sideways trend there, we've incorporated the resistance and support levels where, yes, the price is going up and down, but it's not going beyond those two levels that have been identified. And we've some notes on support and resistance. As we said, the resistance levels are price peaks, supports, price troughs. The support occurs when market buying activities are sufficiently strong to overcome selling pressures. In other words, you're not going to go any lower. Whereas the resistance, it's the other way around, when selling pressure is strong enough to overcome buying pressure. Now, we're told the support or resistance level grows in significance. It's more significant the longer it is traded. So if you're looking over a period of time, then it really is a strong support or resistance level, and the higher the volume of activity. We're then told that once a support or resistance level is broken through, it reverses. That is, the resistance level will become a support if you are going on the way up, and the support level becomes resistance if you're on the way down. Now we consider technical indicators. Three indicators we're covering: moving average, which is reasonably straightforward; relative strength indicator, a little bit more complex; and the moving average convergence, divergence indicator. Well, take that as you will. Moving average, average of a number of closing prices over a period of time, smoothing out price fluctuations. So you're looking at a longer term trend. These averages used by analysts to determine whether a market is trading on an upward or downward trend. And the analyst can use a number of measures. We can look at 10-day, 250-day, 60-day. You can choose whatever time period you're interested in. Now, the relative strength indicator, here we go. Rate of change indicator measuring a stock's strength relative to its own past performance. So it's to do with momentum. If the RSI, I beg your pardon, I'll come to that in a moment. Calculating the R, we get 100 minus 100 divided by 1 plus the relative strength of the stock. And the relative strength is sum of up closes of end days divided by sum of down closes. As I said, top of page 22, it's a momentum measure showing whether a stock has risen or fallen too quickly. Now, these are the sorts of points that could come out in a question. If a stock price rises too quickly, it may be overbought or relatively too strong. In other words, we're expecting it to fall. And if a stock price falls too quickly, may be oversold, and there we would expect it to rebound. Now, the common RSI time horizons, 9, 14, 21 days, and the values range from 0 to 100. Now, these 2 points I would take away. An indicator level of above 70 reflects overbought stock. You expect it to come down. And an indicator level below 30, you believe it's oversold, and you expect it to bounce back. And the third of the technical indicators were given, the moving average convergence divergence indicator, MACD. And that shows the relative movements of the short and long-term moving averages and measures extent to which price leads or lags moving average or the trend deviation. Please have a read through these notes and take what you can from it. 3.4, common technical analysis methods. We've got the Dow and Elliott wave theories. Now, we're told that the Dow theory states simultaneous movements of Dow Jones Industrial Average and Dow Jones Transportation Average to new highs or new lows, confirms major trend in the stock market. Okay. And the Elliott wave theory, market timing strategy, predicts price movements based on historical price wave patterns and their underlying psychological motives. And then we're told that the Elliott wave theory is more widely used. That brings us to the end of technical analysis and to the end of topic 6, the end of paper 8. As I indicated in my introduction to section 3, I would take the technical analysis material with a pinch of salt. I would pick out the bits I'm comfortable with, know it, but I wouldn't spend hours trying to get to grips with moving average convergence, divergence indicator. Paper 8 will have I would say 7 to 8 calculation questions. Some candidates find these challenging. Remember, if the question is taking you too much time, move on. You don't want to continually prove that you are getting the question wrong. When you get to the end of the exam, then go back and revisit the questions that you've not yet answered. You will find that your mind is a lot more settled when you know the exam has got 5 or 10 minutes left. If you still have problems with some of these questions, well, you've got to answer them, so guess. But hopefully you will get some of them down to a 50-50 guess. Paper 8 material, by and large, the questions I would say are straightforward, but some of the number questions, some of the calculations, they can mix it up a little, but that would only be 1 or 2 questions. As I've said throughout this lecture series, the best way to prepare for the SFC exams is to do question practice to get the material into your short-term memory. And I strongly recommend that you go to Examinator.online to the paper 8 questions and apply what you have learnt in this lecture series. Good luck with paper 8.